Gold and silver to rise as debt bubble collapses. So in this video I did last week, it's time for $40,000 gold. We argued, or should I say, Luke Groman and Jim Rickards argues the way out of this debt bubble mess that we're in is to revalue gold, to reduce the debt to GDP. And that is one argument. That's one way of doing it. The other way is simply, and by the way, these guys argue that the Fed won't be able to raise rates, or central banks won't be able to raise rates. They might a couple of times, and then they'll have to do a power pivot. And yeah, obviously they won't be able to fight inflation. So that's that argument. And to be honest, that's been where I've had almost both my feet in that camp. However, Jim Bianco argues something different. So let's cut to a clip from Blockworks with Jim Bianco.
Even a 10% drawdown is something to make the Fed chair get out of bed and maybe reverse course. But you're saying in this new inflationary world, the Powell put has a much lower strike price.
Exactly right. Exactly right. You know, if you want to put it in market terms, is the strike price has been lowered, and it's been lowered quite a bit. And the question is, why is inflation now the priority and not growth? And I think it's about politics. And by the way, most money managers that I talk to, they're pretty bad at predicting politics. They either don't want to do it, or don't believe it matters, or they're partisan in some way and they don't want to let it show one way or the other. But as a group, get 5 money managers in a room, or 10 money managers in a room, ask them about who they think is going to win the election, take the other side, you'll be Nostradamus, is basically the way that crowd typically works. And you know what? They'll tell you that too. The problem now is with inflation, it hits everybody. Inflation, you, me, everybody listening to this podcast is hit by inflation. However, there's a big difference. The Survey of Consumer Finances says that the Federal Reserve study done every 3 years, that 40% of the public has less than $1,000 of savings in rents. So when prices, 7% inflation, goes up more than wages, which has been the case, so you have negative real wages, the 40% see it at the grocery store, at the gas pump, at the mall, every single time they go to the store. And they're not happy about it. And that is showing up in things like consumer confidence, the University of Michigan's consumer sentiment surveys at a 10-year low, the president's approval rating is in the tank. Congress's approval rating is in the tank. The Democrats are panicking because the Democrats are the majority. So we're going to look at it from their point of view. They're panicking that they're going to get wiped out in November. And so when asked in a lot of surveys, what is the number one issue in the country? It is inflation. It is not crime. It is not COVID. It is not foreign policy or Russia. It is not climate change. It's none of those things. It is inflation. It's the number one issue. So in last month's press conference, President Biden's press conference, he acknowledged inflation is the biggest issue in the country today.
Now, the second challenge we're facing are prices.
And he said, in 2 sentences, he said, here's what we're going to do about it. This is President Biden speaking. Here's what we're going to do about it. The job to make sure inflation does not become entrenched falls to the Federal Reserve.
A critical job in making sure that the elevated prices don't become entrenched rests with the Federal Reserve.
In other words, he said, America, you're pissed off about inflation. You hate us about inflation. Well, here's what we're going to do about it. There's this guy named Jay Powell. He's going to fix it for you. And by God, Jay Powell is going to fix the inflation problem. And if equity holders or bond holders have a problem with it, you have a problem with it. The priority now is inflation.
That's a great metaphor. And Jim, how do you think that the Federal Reserve goes about tightening monetary policy? Because it doesn't just go out and hike rates. The Fed doesn't like to spook markets. They do so by sort of, a wink and a nod and saying statements that only people who are paying really close attention, like you get, that typically is called forward guidance, which is actually the name of this podcast. We've seen a rise in short-term rates, and some could say that is in anticipation of Federal Reserve hikes. Others could say the market is tightening monetary conditions for the Fed instead of the Fed. How do you think about that? I noticed that you wrote something to the effect of they still think that the Fed is under control in the short end, but I think it's the short end controlling the Fed. What did you mean by that?
There was a Dallas Fed president named Bob McTeer around 99, 2000. And he said that only hawks go to central bank heaven. And a lot of those Federal Reserve officials believe that true. This is the moment they live for. This is your Volcker moment. Take rates to the moon. Break the back of inflation. You will go to central bank heaven. You knuckle under and just keep feeding the punch bowl in the middle of an inflationary period, you're going to go to central bank hell is where you're going to go at that point. So I do think they've gotten their marching orders. They are predisposed to fight inflation anyway. And now for the first time in 40 years, we've got it. And they're going to do it in a big way. And the market's sitting there going, no, they can't. They can't do that. They can't raise rates that much. They can't impair things. I think they will.
So Jim makes some really good points there. And one thing that a lot of us make the mistake, we just look at the economics. We just look at, the macro, the plumbing of the system, and we don't think about the politics. And, the politics is all about getting re-elected. And he makes some strong points that inflation is the number one issue. It hits everyone hardest. And who gets the blame? The people in power. I've definitely taken, well, I wouldn't say I've had both feet in the Luke Groman, Lynn Auden camp, because as I've said over and over and over on this channel, that part of my portfolio, I am sitting in US dollars. I have a portion of my portfolio in US dollars. Yes, I'm predominantly commodity based, precious metals based, miners, etc., as well as some biotechs and some other things. But I am sitting in US dollars because of this scenario playing out, which could create a liquidity event, the euro-dollar system blowing up, and an absolute rush for US dollars. The Brent Johnson dollar milkshake theory. And it's not just Brent that says that. One of my top favorite investors of all time, Jim Rogers, also says that. And he is holding US dollars, and he argues he hates the US dollar. He thinks it's garbage. But he says that we're headed for another liquidity event, and the US dollar will turn into a bubble, and then that's when Jim Rogers will sell it. So, and Jim's arguments are very similar to Brent Johnson's. And so, look, that does make sense to me. Now, people say, well, no, this is all talk. Well, let's cut to a clip from Mr. Bullard himself.
Yeah, Steve, as you know, we got the hot CPI report last Thursday, I guess, and I think, my interpretation was not so much that report alone, but the last four reports taken in tandem have indicated that inflation is broadening and possibly accelerating in the U.S. economy. So I shaded up my position, and I'm just one person on the committee, but I shaded up my position to say I'd like to see 100 basis points worth of movement on the policy rate by July 1. So I also said I would defer to the chair exactly how to go about that, and he's very good at managing the committee and everything else that goes with this. But I do think we need to front load more of our planned removal of accommodation than we would have previously. We've been surprised to the upside on inflation. This is a lot of inflation in the U.S. economy, 7.5% on the headline CPI. These are numbers that Alan Greenspan never saw They haven't occurred in 40 years. So our credibility is on the line here, and we do have to react to data. However, I think we can do it in a way that's organized and not disruptive to markets. We're only removing accommodation, so it's still an accommodative policy as we go through these initial rate hikes. They're rather cheap, actually, given that unemployment's down at 4% and the economy is expected to grow, let's say, 3.5% to 4% this year. So I think my position is a good one, and I'll try to convince my colleagues that it's a good one.
And coming in from CNBC, Brits brace for perfect storm of tax rises, spiralling inflation, and an energy crisis. And coming in from the Evening Standard, stagflation is here as hits UK economy. And Bank of England says UK households must brace themselves for the biggest annual fall in their standard of living since comparable records began 3 decades ago. As it raises interest rates to 0.5%, says inflation will surpass 7%, they mean CPI, and slashes GDP forecast. Now, remember that the Bank of England, they say that it will peak, that CPI or inflation will peak at 7.25% this spring, but it's worth bearing in mind of their previous forecasts, where you can see in this chart they have been very wrong so far, and I suspect that they may be wrong this time as well. And Ben shared this, and he credited Rafi Farber for this one. But the Fed has never been this far behind the curve in history. Fed's fund rate 0.08%, CPI 7.12%. He says dollar is toast. Good luck reining in that inflation. And the latest ASX 30-day interbank cash rate futures implied yield curve has come out. And, well, last time I shared this, we were looking at about 1.55 from memory by June next year. So a little bit over 12 months. We were looking at 1.5 now. About 2 weeks later, we're now looking at 1.9%. And here's the thing. That's not going to be enough to tackle the CPI problem that we've got. However, if we do this, central banks do this, we know the almighty debt bubble is going to burst, and everything that's been pumped up by that debt bubble is going to burst. So, in fact, I don't even think we'll get there. I think the debt bubble will burst before we even get there. And our good mate, well, not really, but Stephen Koukoulas, the Keynesian, supply chain issues would not be a problem if demand was weak. The fact is demand is strong and the inflation momentum will only build unless demand cools. Inflation is going to be very high in 2022, and while ever money is cheap and easy to get. Mate, this guy is a Keynesian. This guy's been a property bull forever, saying that interest rates have to fall. This guy is now on the inflation bandwagon, and interest rates need to rise and rise aggressively. Not only is inflation rising at its fastest rate in decades, it's also getting stickier. The Atlanta Fed's sticky price CPI, a weighted basket of items that change price relatively slowly, increased 7.5% on an annualized basis in January, following a 4.3% revised increase in December. On a year-over-year basis, the series is up 4.2%. This is insane. So look how far behind the Fed are with their federal funds rate versus CPI. It's never been. I've never seen it like this. If you guys have got a chart that shows that CPI was this, yeah, okay, there was a brief time in 1974 or whatever, but was it 74? Anyway, whatever. So there was a period of time in the 70s where negative real yields were deeper than this. But wow, this is insane. So when does the market expect the Fed to hike? Well, with Bullard coming out and saying 50 basis points in March, well, that's now locked in at 100%. And actually, there's 14% of the market thinks that perhaps 0.75. Remember that it was about 25%. For the 50 basis points, it was about 25% right before the CPI report came out. And actually now you can see that it's now 9 rate hikes by the middle of next year. And Ethan Harris from the Bank of America said 7 hikes. So, 7 hikes may look dovish now. That is a lot of rate hikes. And if we get 9 rate hikes now by the middle of next year, you can kiss the stock market, the bond market, and the real estate market goodbye. She's coming down. And for the first time in history, Australia's ratio of mortgage debt to GDP has just eclipsed 100% of GDP. Just prior to the GFC, the US mortgage debt to GDP peaked at 73%. And Michael Gayard says the most responsible thing the Fed could do right now is do an emergency interest rate hike. Let that stimulus money actually earn interest instead of being gambled and speculated away in stonks. Make the cost of capital actually mean something. Michael, you said this back in June 2021, and I believe it has aged well. And what he's talking about here is actually giving capitalism a go. And I found this tweet from Jared, who's a Bloomberg opinion columnist and host of the Be Smart podcast, also DJ producer. By the way, I don't know if I've ever told you guys, my business partner, he's also a DJ. Anyway, the combination of gold miners, silver, and silver miners make up about 30% of my portfolio. I have a hunch that what's coming next will make it feel like it's not enough. And I really wanted to share this with you guys because my portfolio at the moment is probably very similar. I'm holding just under 20% in the physical, both gold and silver. Mine's probably closer to 40% because I'm holding a lot of gold and silver miners and explorers. And then I've got, on top of that, even some more stocks, both in the energy and other commodity sectors as well. I'm very heavily invested both in the precious metals, in the commodities, both the hard and soft commodities. I have been adding to soft commodities in the last probably 3, 4, 5 months, or second half of 2021 anyway. So yeah, and what's coming? Well, we saw Jeff Curry talking about the supply issues in the commodity sector while the demand, this asymmetric play just lined up perfectly. I've shared on this video so many times that Chris McIntosh from Capital Exploits has also been talking about this for some time, that this transition, this energy crisis and this transition to a new energy system, I really hate using the word renewable and green and all that sort of stuff because, well, if you look into it, it's nothing but that. Well, it's nothing like that. We're going to see very high CPI. And I don't see how central banks and governments can turn the tap off the, basically the helicopter currency. So, yeah, I see a huge commodity super cycle and I see devaluation of the currency. And I've never been this overweight this sector ever before in my investing or trading career. And I've shared this chart before in other presentations, but when you look at real assets relative to financial assets, these are all-time lows. These are all-time lows. And with the state of the monetary system the way it is right now, it's really hanging on a knife's edge. I want less financial assets and I want more real assets. Commodities. Yes, I still got some real estate, even though I've been selling it because I think we'll see some slightly higher interest rates, which might put some price issues on that because it's debt related, and precious metals. And I love this tweet from Ben. Just as in prior crashes, the Federal Reserve has saved the stock market by printing enough currency. He knows the difference between currency and money. And manipulating interest rates so stocks quickly recover. This time around, the Fed put won't work. Dip buyers will be punished. Now, if you follow George Gammon, George actually talks about and goes through the timing of the announcements that the Fed did and whatnot in March 2020. And even when the Fed announced that they're doing, corporate bond buying, the market was still going down. And George argues it wasn't until the government announced huge fiscal spending, huge payments, that the market then went, oh, cool. And so George actually argues that we've gone from a Fed put to a government put. And, he might have a point there. And once again, Ben shared this, the Wilshire 5000 GDP ratio, or the market cap to GDP, which is a measure of the total value of all publicly traded stocks in a country. Obviously, this is the US, divided by that country's gross domestic product. As you can see, the average is about 75%, with a few spikes over 100%, some periods below 50%. Currently, we are at 191%. He says bubble. And actually, it did touch over 200%, which is incredible. I was calling this thing a bubble when it was like at 140. Even after the crash in March 2020, it was still overvalued in my humble opinion. So what have we got coming? What's in store? I think we're in store for some very, very difficult times for most people. And this is a fantastic chart from Real Investment Advice. You can see, it's interesting to see the amount of years of zero returns and when the Fed became active and the QE era, and just the exponential growth in the S&P 500. And you can see the green line there, the mean. So, if the S&P 500 reverts to mean, it's got a long, long, long way to fall. And you know what? Even if it doesn't revert to mean, I think we're going to go into a period, best case scenario is basically zero returns for quite a long time. And if we adjust it for inflation in real terms, wow. How long do you guys think? What do you guys think? How long do you guys think that we're going to have zero returns? If someone buys the market right now, do you think they're going to make much gains over the next, say, decade? You think they're going to have losses over the next decade? Or I'd love to see your thoughts in the comments below. So it's pretty clear that the Fed has been feeding the bull market. Central banks around the world actually have been feeding the bull market, not just in the S&P 500, not just in their local stock markets, but bond markets and real estate markets. And the only thing that they haven't pumped up is gold and silver. And in this chart, we've got the ING central bank forecast. So this is the movement both in rate cuts and hikes, and also QE balance sheet change. And so you can see the Fed, what's that, 1, 2, 3, 4, 5, 6, 7, 8 rate hikes, they think, by the third quarter next year, with a couple of balance sheet changes. I'm guessing they're thinking quantitative tightening. ECB not doing much. Bank of Canada doing quite a bit. And the RBA here in Australia also doing 6 hikes and ending QE, which they've already announced. So that's quite a bit of movement. As I've shared in other videos, when you look at, compare it to the 1980s and all the, debt to GDP, debt to income, all that sort of stuff, a 1% move, a 0.25% move today is the equivalent to a 1% move in the 1980s. So, if the Fed are going to raise, 8 times 25 basis point, that's an equivalent to an 8% hike in the 1980s, and for Australia, a 6% hike. And that's the impact that it's going to have. So if you pitch yourself, those of you maybe a little bit older, who were around in the 1980s, and if you could picture yourself having, a 6 or 8% rise in interest rates, what that would do. Well, yeah. Here in Australia, a lot of people that bought, especially first home buyers that bought after 2010, they've never even experienced a rate hike. They don't even know what it's like. So I think some people are going to be in for a rude shock. And this is a chart from Australia. This is investor borrowing for home loans, for investor loans. This is record territory. Never been higher. And we had APRA come in 2014 when they said the investor market was getting too hot and came in with huge regulations. In fact, some banks just stopped doing investor loans, and you saw it plummet significantly. Is this what Mises called the crack up boom? Because of cheap funds from central banks, it's easy to get financing, especially for homes. Our banks, 65% of their balance sheet is towards the residential mortgage market. They have leveraged their wagon to property prices. Is this a crack up boom that Mises warned about? And I'll just end this video. I'll come back to Jared's tweet. With all of the craziness going on, I can see asset prices absolutely tumbling. But I think we're heading for a decade of high CPI through both monetary debasement and through the energy crisis. We've got that to deal with. And so as a fundamental value investor, I look at buying things that are undervalued. And I'll repeat Jared's tweet. Combination of gold, gold miners, silver, and silver miners make up about 30% of my portfolio. I have a hunch that's what's coming. I have a hunch that what's coming next will make it feel like it's not enough. And I've done videos on the asymmetric trade between supply and demand in the commodity market. And that includes the precious metals as well. And I think there's an asymmetric play there. I think, just buy them while they're dirt cheap, unloved. Sprinkle a little bit of time on it and watch it do its thing. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, guys. I'll see you all again on another episode of Finance Uncut.